Is it traditional economics? Is it Irving Fisher economics, where right now the currency links right into interest rates, links right into inflation, and shows potential dampen GDP and, frankly, crisis?
Yes, there is a severe risk of a balance of payment crisis, of a sudden stop of capital. There's a huge amount of dollar debt, especially in the banking system, the corporate sector, and the currency going from 3 to 5 to 7, now is around 6.3, implies a massive negative balance sheet effects on the corporate and the financial sector. That's why actually the currency is not leading the fall of the currency to an economic stimulus. If anything, the economy now is going into a recession. The latest economic data suggests that Turkey is going to have a credit crunch, is going to enter a recession by probably the third quarter of this year. So you have the impact that the currency depreciation with dollar debt is contractionary rather than being expansionary. It leads to higher inflation. It forces the central bank to hike rates. Finally, they've shown some independence. But monetary tightening is not sufficient because you had massive fiscal, quasi-fiscal, and credit stimulus in the economy that led to overheating for him to win the election. And therefore, now they have to tighten also credit, fiscal, and quasi-fiscal policy. But they have a regional election next March. And therefore, they want to avoid the recession because they want to win those important local elections. And therefore, they're not tightening the fiscal and credit reins as much as they should.
Right. So, Nouriel, what will it take to put Turkey on a more stable footing? It seems that, the central bank actually did quite a lot, and yet investors aren't convinced.
Well, in Argentina, the policy rate were pushed to 60%, with inflation slightly above the one of Turkey. In Turkey, finally, they pushed them from 17 towards 24%. That's a positive, especially because it signals that the central bank is now slightly more independent, even if Erdogan, the president, keeps on attacking the central banks and the interest rate lobby. But as I pointed out, you had massive imbalances, both internal on the fiscal side and the savings and the spending of the private sector, and external with a very large current account deficit. Therefore, you need monetary tightening, probably more because inflation is going to rise, fiscal tightening, and credit tightening. But that implies you have to accept a recession. The economy is already going into a recession at a time where politically his support is deriving by having strong economic growth, and you'll have election coming next spring. So I don't think they're going to be doing enough, because if they're doing enough, they're going to plunge the economy into recession. At this point is unavoidable. And therefore, the weakening of the currency is going to continue to occur even after this monetary tightening. We've seen in the last couple of days as the currency is weakening again. And there are political uncertainties as well. So they're not doing enough.